oldest method of investing, in my opinion, has been value investing or fundamental analysis, where you can evaluate business quite successfully by reviewing its key operational activities and the market size and so on. But since then, especially in the last 100 years or so, if you look at the number of companies, it has evolved tremendously. We have thousands and thousands of companies. And in order to assess each business, basically, you need the help of technology and go through the millions of lines or millions of data points. And at the same time, not everybody has the courage or the patience to let the market realize what the true value is of the company and go through the volatility while you're holding the stocks. So in such a situation, there will always a need to find out an alternative investing approach. And that's when the technical analysis was invented. And if I remember correctly, I think it was around 120 years or so, based upon what I read, that Mr. Charles Doe in US studying the price and then coming up with a measurement or with a way to actually invest markets based on the price actions. Now, since then, there have been thousands and thousands of indicators. You can look at like Fibonacci's, the moving average, the RSIs, the ROCs, and so many things. If you were to categorize most of the technical indicators or technical studies, it all boils down to only two things. And those things are the study of price and the study of volumes. And based upon these two factors, almost all the indicators have been derived. So for example, moving average is nothing but the moving average of the price. So in a way, it's a study of the price on how the prices have been displayed during the last 15 days, 20 days, depending upon your moving average length. And then there were further evolution of moving average. Then came like exponential moving average, Hull moving average, weighted moving average, and so on. If you go to the root, you will find that it is the study of the price that has been factored into it. Then the other variable that is studied the most often is the volume. And then you will find the volume at this certain price, how much was the volume at this price, what was the volume. And then geniuses came up with several ways of measuring the price and the volume and conclude whether these are going to be overbought markets or oversold markets. So at the end of the day, price and volume is what is at the root of almost all the technical indicators. What's up, you all? This is your coach Manoj at optionpreneur.com, #1 website for smart traders and investors worldwide looking for safe, stable, and consistently profitable income strategies, especially trading options. And if you have not subscribed to our channel, make sure that you do that now. Hit the bell icon so we can notify you whenever we are publishing the new content or the new video tutorials. And if you're enjoying the content, hit the like button and spread the channel, share this channel with other friends who might benefit from the same as well. Now, let me share with you how to get started with technical analysis and understand the basics of it. This is not a technical analysis course, so I will not be going deeper into that. I will be introducing to you some of the powerful indicators in the future tutorials. But for the purpose of this particular video, I would like to share with you, how to do a basic technical analysis. Let's say, for example, I'm dealing with Tesla. So I have a stock symbol here, which is Tesla. Then I will look at how the prices have been. On horizontal axis, usually there will be a time frame, and you can begin with, say, from Jan till December. All right. So on vertical axis, you will see dollar sign, and this dollar, it is showing you what the price was. So let's say at some point, the price was $20, and at some points the price was, let's say, $50 and so on. These are just for an example. Now, how these prices are being displayed, that will also define these prices. When I'm showing these prices, how these prices are being displayed, that will also define the type of charts you have. Okay. Now, let me show you different types of price displays. So the most popular one is called candlestick chart. And here you will have a high price, and you will also have the low price. And then you will have either the opening here and the closing here. So there are typically 4 prices that you will see on any candlestick chart. And depending upon whether close is greater than open or close is lower than open, you will define whether it is a bullish candle or a bearish candle. So just keep that in mind, that these candles are of 2 types usually, and those will be either bullish candles defined by green colors, and you will have another one which is defined usually by the red color, and you can say those are bearish. And the difference between these two is naturally where your opening price was. So if opening was here, closing was here, it is typically bullish. If opening was here and closing was here, then this is typically a bearish candle. So you understand how the candles are being done. Now these candles then are displayed on a chart. So let's go through it and understand how those candles are being displayed on the chart. What you have on the screen is the price display. So this is again a time, and this is the dollar value. So I'm just going to display some candles here. So as you notice that each candle has four prices: high, low, open, and close. And then these prices are displayed in various indicators that I was explaining to you. So this type of chart, when you see these candles are being displayed, it's called candlestick chart. And then you can display these prices in many ways. So one was the candle. Actually, another one is also called bar, where you can have an open price and the closing price like this. Once again, high, low. So high, low, open, close, open, and then close. At the end of the day, when you've gone through this, you will find there are four major types of charts. What those four major types of charts? One is candle chart, second is bar chart, third is the line chart, and the fourth is area chart. Depending upon how you're looking at, you can choose what type of charts you like. There used to be another type of chart as well, which were used by old market technicians and still in use by some of those, and it's called point and figure chart. And those are done by crosses and the zeros, so like the crosses, crosses, and then zeros and zeros. These are, for developing a point and figure chart. Now, that is on the top portion of the chart. Similarly, at the bottom portion of the chart, there will be another study which will be displaying what was the volume during this bar. So what you see here is typically it says the number of shares or number of units or whatever that particular underline you were using. And all the technical analysis and most of the time are just the derivatives of either the price or the volume or the combination of the two. Okay, and once you understand, once you figure out how these things are being displayed, you will be able to make sense of this. So let me share with you how a chart will look like and what are the different components of a chart. The thing you are seeing on my screen is from trading view. Here's the stock symbol, for example AAPL. So everything starts with a stock symbol, right? And you will see these are the prices which are displayed for every day from the month of July until now. Each candle here represents the price action within that day. So if you look at this on 19th of Jan, you will notice that the opening price for this particular stock, Apple, was 170 and it closed at 166.23. So that's why it is showing in the red color, because it was a bearish day. And for these things, the price actually opened lower and it closed higher, and that is why it is showing in a green candle. At the bottom, you will notice that these bars are showing you the volume. Now, the question comes in, why would people will trade using technical analysis? What are the advantages of using technical analysis and so on? So here, if I show you a list of indicators, you will see that there are just so many indicators, right? There are hundreds and hundreds of indicators. What happens is you take these indicators or someone take those indicators and actually convert into a formula or give it to a machine. And then that machine produces two very, very important things. First important thing is the scanner. So the scanner produces the results which meet certain criteria. And the second important thing from that is the indicators which are visual that you can display on your chart. So once you have those things identified and displayed on your chart, you have a list of the stocks that you can trade. The trading or investing becomes easier. And that's where the greater use of technical analysis is, and it's been evolving ever since. So once you understand technical analysis is all around price and volume, and you understand the usage of indicators as well, you can dive deeper, understand more about technical analysis, find and research the indicators that are useful to you, go back and do the back testing and see if you would like to use that. Let me show you how it looks like in Thinkorswim trading platform. And you will notice that, for example, I have many lines here displaying certain things, some studies that I've done. And for example, here it has generated a bullish point for me already. meaning that, okay, Manoj, go ahead and take a bullish trade. The prices are displayed here, and in real life, real time, the prices are moving up and down. Can you see that? Yes, so those some of the studies which are being done, and at the bottom you will see the volume. Now you can attach many more indicators that you like. So why would people follow technical analysis? The reason behind this is simple, that their trading time frame is usually short, and they would like to make those decisions, rather get into the trade, get out of the trade in a short period of time. They are not willing to keep the trades for a very long run. Okay. Now, this is how technical analysis looks like. It helps you in terms of making the decisions, and it makes it emotion free as well, because if you start to follow a certain system, certain indicators, you can say, okay, that's it. But there are again thousands of companies, and in order to trade, you would also need a large pool of capital. And those indicators are just indicators. It may go up, it may go down. You don't know whether the markets are bullish, whether the markets are bearish. You will just follow what your systems are saying, correct? So is there an alternative way? Is there an alternative way to trade these things at a smaller capital? For example, if you were to buy Tesla, is $1,000 a share. And if you were to just buy 100 shares only, you need 100,000 US dollars. So can you participate in the financial markets with a relatively lower capital? Can you also build strategies so that you're not dependent upon bullish market or bearish market? Absolutely, you can. And that's what I will be answering in my next video, where I will introduce you to the concepts about market neutral strategies. How can you trade with a fraction of the capital and participate in the same market? And for your homework is, what are the key pros and cons that you think are there between fundamental investing and technical investing? Which one attracts you the more and why? So write your thoughts and your answers in the comment section below, and I'll be more than happy to read that and come back to you with my thoughts as well. I look forward to seeing you in the next tutorial. Till then, stay safe, stay healthy. This is your coach Manoj. See you again.